Ladies and gentlemen, welcome to our first Investor Talk interview with a mining CEO, Keith Neumeyer, CEO of First Majestic Silver. Keith, you have been a pioneer in the past and you are one again today. Welcome. How are you?
Thanks, Jan. Nice to see you electronically. Nice to be your first interview as well. I always get to see you once a year in Munich, and
right.
Nice to see you over the internet mid-year.
Keith, you have a background in the brokerage business. What's your impression or what's your opinion about the current market situation? We see the stocks are close to record high. The Dow is up today. Again, it's 500 points to the record high. The interest rate is at zero. We have negative real rates. Precious metals, okay, they have a little jump today, but not much enthusiasm there. What's your opinion about this insane market? So you have my opinion already.
Yeah, look, there's just so much energy behind the U.S. market, and not only does the U.S. government not want the U.S. market to go down, so the Federal Reserve and the plunge protection team and all the central banks around the world are all working in cahoots to keep this system up for as long as possible. And the reason why that is because there's a direct relationship between taxes and what the stock market is doing. And then that's a very clear correlation, and you can get information on that correlation if your listeners wish to do that. And it's quite fascinating. So, the U.S. government allows the stock market, or not just the U.S. government, the German government, any government allows the market to go down, their taxes drop. And the economy is not particularly strong, but the strong part of the economy is the market. So, the high taxpayers, or the top 10% of the wealth on the planet is really 100% of the stock market. And it's that 10% that, in my view, are paying all the taxes to really take the pressure off the governments, to actually do the tough things they need to do to actually start to right the ship. But they don't want to do it. It's too difficult to do. They're all short-term governments, and then they look at their next election, and that's all they care about. So if they can keep people in the shopping centers and keep the stock markets up, then they look at that as being successful.
Interesting. I didn't think about it honestly, but the governments anyway they take the money from loans. They don't rely so much on the taxpayers' money. The U.S. alone, I think, has a deficit of 1 billion. Nevertheless, the fundamentals for the precious metals are very good. I just saw the World Silver Survey, and there, if you see the numbers there, we have been in a deficit for many years. I showed to our audience a slide quickly that I have prepared. Here we see the numbers from the current World Silver Survey, and where I have put there a bold black line, we see the net balance up to 2018, and you know it yourself, a market that is in constant deficit and the silver price not moving upwards. This is something that stinks for me. What do you think?
Well, quite honestly, these numbers are made up. So, there is definitely a deficit. I would 100% agree with that. But the institute, I'm a member of the Silver Institute, and the Silver Institute uses GFMS for their collection of supply-demand fundamentals on a global scale. And who owns GFMS? Blackrock. Who owns the biggest silver ETF and the biggest gold ETF? GLD and SLV. Blackrock. So you got a situation where you've got the owners of all these ETFs actually publishing supply-demand fundamentals on the metals. And it's
I think there's a tiny conflict of interest.
Just a small conflict of interest. And I've been very vocal at the Silver Institute about that particular issue that I have. And we're actually now in the process of it's coming to the board, and I am a board member now. I've just been appointed a board member of the Silver Institute, and my vote is for another collection agency to be the sponsor of the upcoming silver report, which will be published in 2020. I will see if my vote counts. There's, I think, 12 of us on the board, so it will be interesting. But I'm trying to break that relationship because I think there's a lot of false data behind it. And I've spoken directly to Samsung. I know others who have spoken to jewelry companies. And I know for a fact that Toyota or Tesla or Sony or Samsung or Apple, they're not going to tell you how much silver is in any of the devices they produce, because they're absolutely paranoid that if the hedge funds of the world actually knew how tight the silver market was, that all the hedge funds would front run them all. And all of a sudden the metal would be probably 2 or 3 times where it's currently trading. So the headlines are always quite negative, and don't talk about, the real fundamentals. When you just saw that, you showed that chart, and it showed multi-year deficits in silver. But have you ever seen an article that shows up on Bloomberg or shows up in Barron's or shows up anywhere that says silver's experiencing multi-decade short positions, or supply issues? And of course they're paranoid about that story ever hitting the public markets. And the silver market is about a $16 billion market. If you consider the miners are producing about 850 billion ounces, or pardon me, 850 million ounces a year, and recycling is about 150 million, that's 1 billion ounces. At $15 silver, that's $15 billion. How many times did that fit into Apple's market cap? How many hedge funds on the planet are big enough to be able to move silver $1 at one time if they wanted to do it? They can do it extremely easily. So, and everyone knows it. So there's a huge paranoia out there from the huge consumers who knows the market's extremely tight for actual real information to be published globally.
Keith, the 1 billion ounces that you just mentioned are interesting because in the report of the World Silver Survey, I found the information that the OTC trading volume 2018 was 165 trillion ounces. That means 4.85 million tons of silver, OTC trading volume. Isn't that, so the silver market must be important for those guys to use it like a casino. It's the same with gold. Why don't they focus on agricultural goods? I think the precious metals are for a reason such a manipulated market, because they are of such high importance.
Well, that's exactly true.
No explanation.
No, that's exactly true, and it's unfortunate because the flaw in the system, and I've said this 100 times, is that the COMEX system or the London Metals Exchange system was set up in order to create a market for consumers and for producers, and it was designed to take the volatility out of price, so that if you're a big consumer of the metal, you're Sony, and you want to buy a year's worth of supply, you can do it, and you can do it through the paper markets, and you would find a legitimate seller, a miner, who would enter into that contract with you and would give you a year's worth of supply of whatever metal, silver in this case. And it worked for some time until the banks figured out that there was no limit on how much they could sell, but there is a limit on how much you could buy. And that's completely screwed up. It's very one-sided. So if Sony wants to go and buy in the paper markets 50 million ounces of silver to allow them to produce televisions for the next 12 months, they're actually not even allowed to do it. The maximum amount of contracts that any one consumer can purchase at any one time is 1,000 contracts. So during the contract life, you can only own 1,000 contracts for that whole life of that option or that contract. But on the sell side, if you're JP Morgan or HSBC, they undercut the producers, right? And because the producers aren't going to sell, 1 million contracts in a day because they don't even produce that amount of metal. The producers would only sell what they can produce. But the banks figured out that as long as there's no limit on the amount of paper contracts that they could write, they could fill all those orders without any problem at all. And that's what they do. So you have the entire banking system who is supplying all these manufacturers on a global scale, and silver is becoming more and more important, particularly now we're getting into electric vehicles and solar panels, and the consumption of the metal is actually increasing quite nicely. So there's a very bullish environment being built for the silver sector, but yet these big banks are still allowed to sell an unlimited amount of paper silver without any repercussions. So and they know the miners have to sell, and they know the miners are going to be selling every once in a while. We don't sell our silver every day. I go in the market maybe once a month or maybe twice a month at the most. And most mining companies do the same thing. And the banks know this because they see how the miners work. And they just wait for the miners to come up with actually real physical metal to sell into the market. And they're short, to Sony, to Tesla, to Apple. And then they just buy the metal from the miners, and they're happy as can be. And until the regulators put a limit on what the banks can sell, then this whole system is still going to continue on as it is.
Keith, we have to come to your company also. That was the main reason for our interview today.
Okay.
First, Majestic Silver, one of the large silver producers in the world.
Yeah.
You published your annual results a while ago. 11.7 million ounces of silver plus gold. In total, we have 22.2 million ounces silver equivalent. We had a very nice operational cash flow, which is not common in this market environment. Nevertheless, a net loss of 200 million. Could you comment on it?
Well, those are write-downs, right? So, unfortunately what happens, and this is an argument I have with Deloitte on a fairly regular basis, it seems now that we've gone, I think 5 years in a row now, I think we've had to write down our assets. And it's very, very frustrating because the silver doesn't go anywhere. But, unfortunately, back in 2011, silver was $50 an ounce. So the auditors would put a value on those ounces in the ground, and at $50 an ounce, the silver in the ground is obviously worth substantial amount of money. Over time, and the ounces haven't changed much. We still have around 500 million ounces of silver sitting in the ground. But the auditors over time, as the price of the silver drops, you say it's around just shy of $15 an ounce, which is quite a lot lower than it was obviously a few years ago. The auditors say, okay, you got X amount of silver, it could cost you this much to take it out of the ground. This is what we value that asset at. Last year you had the asset on your books at whatever number, 50 million. And today we think that asset's worth 25 million. And I say, well, and I say to them, I said, come on, the silver's still there. How can you do that? They say, well, that's just the rules. That's the rules that we follow. That's the rules we have to follow under IFRS, the accounting standards that most of the planet, works on. And I, of course, even though I'm the CEO, I can't tell the auditors what to do. They tell us what to do, unfortunately. So, we end up having to write down our assets, and it's happened now 4 or 5 years in a row. It's quite distressing. And, I think most of the sophisticated investors know it's all nonsense. It's just paper. it doesn't mean anything. But some of the retail investors who are less sophisticated and don't understand how accounting works, can look at this and say, oh, the company's losing so much money. And it's not really that we're losing money, because that's not real money. It's just a number on the balance sheet that disappears. It's not a cash number. It's not a real loss. It's basically a non-paper loss, but it does show up as a loss, and it's a big number, and it's it does affect the industry. The funny thing is, Deloitte tells me, well, when silver's prices go up, then you can write the asset back up. Can you imagine?
I would have asked you that, really.
Yeah, no, this is what they're telling us. So all of a sudden, because under the new IFRS rules, you're allowed to write assets back up. So Canada's only been using IFRS since, I think, 2014 now. We're one of the last. Europe was much sooner than Canada. But nevertheless, when we adopted these standards, they told us, oh yeah, you could write it back up. So can you imagine, silver's $25, and the auditors come to us and say, yeah, we think you should write your assets up by $200 million. So we have this huge gain on the bottom of the balance sheet, and it's going to be bullshit, complete nonsense. But yet,
they will tell you only if it's sustainable for 5 years, and it's a bogus.
Yeah, I don't know. We're not there yet, obviously, but the whole accounting world is I don't know. You have to look at, when you're looking at a mining company, look at the it's the line. It's about third line down on the financial statements, in the income statement. It's called mine operating earnings. That's the number that investors should look at, because that's actually the amount of cash that the mines are generating. Everything below that line is just taxes and stock-based compensation, depreciation, things that really don't affect cash. You need to know what affects cash, and that's the mine operating earnings.
Keith, this market is stressy for all of us in this business, but on the other hand, it forced the mining companies to become very efficient. And I saw in your presentation that you have taken several measures to improve the recoveries. What is your what is the focus of your works this year to improve the economic or the efficiency further?
Yeah, well, thanks for bringing it up, Jan. Back in 2014, well, actually, it started in 2012. When the metal prices started to drop, I got very concerned, because it started to drop very quickly. Like silver went down $10 in a matter of 30 days or 60 days, and it didn't look like it was going to recover, and it obviously never did. So I decided, and our costs at the time were about $25 an ounce, but silver was $50 or $40, so it didn't matter. We were making tons of money, tons of cash flow. The stock was doing very well. But unfortunately, I did, do the right thing, and I was extremely proactive, and I put together an internal IT team, and I gave them clear instructions on trying to find technologies available in the marketplace that we could deploy that could start attacking costs. And that started in 2012. So by the time 2014 came around, we had already started implementing a number of automation tools in the mills, and very simple things like pH control, lime feeding systems, cyanide feeding systems, belt speed monitoring, automatic sampling systems. And it didn't cost a lot of money, but every time we did one of these things, we saw a cost drop and recovery went up. So we started doing this throughout the entire business. And back in, we have stats. It's actually in our presentation. People should look at it. It's on our website. But in Q1 2014, our average recoveries over the 6 mines was 65%. Which means that we're getting 65% of the silver out of the rock that we were pulling out of the ground. And that was considered standard, okay, no problem. The rest of the silver just goes in the waste. And for most mining companies, that's acceptable. But but over time, as of just last quarter, ending December 2018, our average recoveries were 87 or 89%. So, and that's over a period of 4 years, a little over 4 years approximately. We're able to increase our recoveries by 20 some odd percent, which is huge, and because it didn't cost much to do it. And so today our costs are in the $14 range, globally across all mines. Some are lower, of course, but some are a little bit higher. So the average is about $14. So that's a huge improvement. We were able to knock over $10 an ounce of costs out of our costs just through automation in the last 5 years. And there's a number of technologies, and we talk about it on our website as well. I was in Austria just in August of last year, where I was watching the manufacturing of some mills, brand new technology mills that we've ordered. One just arrived at one of our mines just last week. It's now being installed. Another one's on a ship. We ordered 3 of them. And so it's pretty cool. I went to this manufacturing facility in small town Austria, and watching them make these things. And they had only sold a half a dozen of them, but all of the companies that are buying them are the leaders in the industry. First Quantum, Tech Cominco, Goldcorp. Companies that are really at the edge. And we pride ourselves as being one of those companies. We're not that size, but we're doing everything we can to stay at the cutting edge of technologies. And we think we can get our recoveries north of 90% over all our mines by the end of 2020.
And with those measures, you are then prepared for the next move upward, and the cash flow should look really healthy then. Keith, I found in your annual report that your all-in sustaining costs were $14.85, not 95, and currently we are close to this level. So you are at break even now. Do you have a rough guess if the silver price, for instance, increases by $10? How would this affect your cash flow? Any guess or any number there?
Well, we're producing something like 27 or 28 million silver equivalent ounces a year. So, a $10 move in the silver price would be, 270 million extra revenues, and it wouldn't cost us a lot more. It's just pure revenue. Our costs would stay much the same. So most of that revenue would go right to the bottom line and become pure profit. So, that would be pretty amazing, and we're hoping for those days to come again.
I hope so. Yes.
We're pretty certain it'll happen. But look, in the meantime, we just have to we have to look for ways of improving the business. I think we've proven that we've done a pretty good job. We have 2 mines that are producing 75% of our production and 90% of our profits, and we have 2 mines that are basically break even. And one of them, we have an investment going on right now, which we hope that's the roaster at Lincoln Tata. So we hope once that roaster is fully up and running, Lincoln Tata will become much more profitable than it currently is. So we'll have 3 mines that are profitable at that point, and then we'll have the 1 mine that's breaking even, San Martin, which is still a fine mine, but it's tough at these prices. And then 2 mines, of course, losing money. And it's just a matter of how long do you run them at a loss, and and it's a decision to keep them open for now. We might.
Maintenance is also not for free, so.
No, you shut it down. There's cost to shut it down. You got to pay severance, and then you still have to have staff on board, for security reasons, and then you don't want all your mill just picked up and taken away by. So you have to have security in place, and so there's definitely care and maintenance costs and closing costs. So you have to weigh that, and so you lose $5 million a year, and to keep it running, or just care and maintenance alone would be $5 million a year. So what's the difference? You're still going to pay to spend the $5 million. So you might as well keep the 300 or 400 people employed, because those jobs are super important for the community in the area. And if you shut the mine down, then you create this whole ghost town, which is a huge problem in Mexico. But your cost of $5 million remains the same, but you just created a huge problem in the town. So these are the kinds of decisions that mining companies have to make.
Keith, we are close to the end. I found an interesting statement, I think, in your PowerPoint. There was written that you intend to grow First Majestic to the biggest silver producer in the world, but that is really ambitious. You have to fight Fresnillo and many others, Glencore. 15 million ounces are planned, as I read, for this year. How do you want to achieve it? Mergers and acquisitions. Last year you took over Primero and the San Dimas mine. I think from organic growth, it cannot it cannot come from organic growth only. How do you want to achieve it?
Look, I can. The reason why you've seen Barrick get taken out by Rand Gold and then Goldcorp get taken out by Newmont is because it's cheaper to buy mines than it is to build mines. Our last two acquisitions, the Santa Elena mine in the end of 2015, we paid $105 million for Santa Elena, and I can tell you today, to build that, it would take you 10 years to build it from start to finish. That would probably cost you $300 million to do it. So we paid $105 million for it. So and it's profitable. It's spinning off $5 million a quarter in profits, even at current metal prices. San Dimas, we paid $320 million for it. That company had a market cap of $1 billion 5 years ago.
I know.
It'll take us about 3 years to pay back that investment of $320 million, which is reasonable. It's just spinning off, $12-15 million a quarter in profits right now, in that range, 10 to 13 million in profits per quarter. It's a big mine, big asset, and underinvested and needs more time and more money, more growth. But San Dimas will be a bigger mine, and it'll remain our largest mine for probably a long time in the future. So we've got two fantastic mines, and even if we were to discover a grassroots asset tomorrow, because we've got a lot of rigs moving. We've got about 30 drill rigs drilling right now. We've got about 200,000 meters of drilling happening this year in Mexico, and we could discover a major ore body. And let's say we did tomorrow, it would still take you a minimum of 5 years to get it producing, and likely longer, to build the mill and get all the permitting in place and everything else. Build the infrastructure, all the water infrastructure, electrical infrastructure, everything you have to do to get a mine up and running. It takes a long time and it's very expensive. But for us to go buy a mine, we could do that tomorrow. So we're looking around. We haven't stopped. I put this company together 17 years ago, and every single acquisition we've done, that mine we bought was our biggest mine at the time. And this is what some people forget about that, because La Paria we bought, it was the biggest mine. Small today, but at the time when we bought it, it was the biggest mine.
Right? A long time ago.
A long time ago, but look at San Martin, Lincoln Tata, every single mine we bought, it became the biggest mine. Santa Elena was the biggest mine until San Dimas, and now San Dimas is the biggest mine. What's next? I don't know. I can't tell you, but we're always working.
What our visitors might be interesting for them, the gold and silver ratio is now at over 85, and you have such an interesting chart in your presentation that I will link also to the video. And usually once we have such an overshoot to the upside, it comes down to the 40 and 50 range, which means silver is very attractive in relation to gold now. And if there are people interested in silver, of course, first I recommend to buy physical silver that you have in your own possession, but then a good silver stock. And a good silver stock, I mean a silver stock, not a company with some silver credits that has silver in the name. You have 60 and something % of your revenue silver, and others like Pan American or even Fresnillo have a third or less. So if you really want to invest in silver, you should look at a silver company with the majority of the revenue in silver, right?
That's my view as well. And you know, one interesting thing, and there is a slide towards the end of the PowerPoint presentation.
Here we see the slide. That's the slide.
Yeah, and what's interesting here, and a lot of these companies are quite well known. You know, but when I put this company together 17 years ago, most of these companies were over 50% silver, and over time they've been, you know, degraded, you know, much lower, with even Pan American at less than 30%, which is pretty shocking. And Silver Standard ended up changing their name to SSR Mining because they're you know, less than 20%. So and this tells me that there's a lack of silver mines out there, and because if you ask any of these CEOs that are behind these businesses, they'll tell you we didn't purposely mean to become gold companies, you know, but in order to grow, we just couldn't find a silver mine. So we had to buy a gold mine. So now today we're a gold company, and they keep the word silver in their name because they know that, you know, silver, you know, has they're rare. Silver's a rare company. So if people want to buy a silver company, they might suck some people in to buy their company just because there's the word silver in their name. But when you look at how silver prices move and how First Majestic moves, there's not a stock on the planet that has the correlation to silver as First Majestic does. You know, you go back to 2016, for example, and in January 2016, the stock was around $4 US at the time, and silver was around $13.50, and it just got knocked down. It was, you know, November, December 2014 or 2015 was quite bad months for the metals, and then everything kind of bottomed out in January 2016, and then boom, everything exploded. You know, silver went from around $13.50 to just close to $21 in July. So in a 6-month time frame, silver went up approximately $7. Our stock went from $4 US to $21 US, or it went to $26 Canadian. So basically, it went up 7 times, and silver went up. No, pardon me. So silver went up $7, and then we went up 3 times the amount that silver went up. So we went up $21, and silver went up $7. So 3 beta, you know, compared to what we were trading at before. There's no silver company out there that has that type of leverage to silver. So it's, you know, if there are people that want silver in their portfolio, yes, they should have physical silver for sure. I've got lots of physical silver myself. But, you know, from if you really want to make the big win and you're bullish on silver, you need to buy good silver equity. And First Majestic should be, in my view, you know, one of those stocks that people consider.
That's a fantastic final statement, Keith. I wish you the best for this year, further success with your optimization measures, and then I see you in November, I hope.
Absolutely, we'll be there.
Thanks, Keith. Have a good day in Vancouver.